three things that you need to know to start the day.
First up, stock futures trading in the green as traders digest the latest inflation print and jobless claims. Producer price data coming in a bit hotter than Wall Street's estimates. The jobless claims and continuing claims were lower than expected and a positive read for the economy.
Plus, investors bracing for additional tariffs, as President Trump said he would announce reciprocal tariffs on imports from countries that impose higher duties on U.S. goods. The White House press secretary indicating that Trump was planning to announce the tariffs program before his meeting today with Indian Prime Minister Narendra Modi.
And on the earnings front, shares of Deere taking a hit as the world leader in farm machinery anticipates another challenging year. Steel and aluminum tariffs likely to raise production costs as well, while any retaliatory tariffs could hit demand for agricultural goods and also limit purchasing power from farmers. Meantime, shares of Robinhood surging today after the company reported revenue that more than doubled as the online trading firm was boosted by crypto market transactions around the U.S. presidential election.
U.S. stock futures wavering this morning as investors digest the latest inflation reading, labor market data, and await reciprocal tariffs, which the White House says could come as soon as today. Futures right now, they are holding on to some fractional gains inside of 30 minutes until today's beginning of today's trading session.
Yeah, a little bit hot when it came to that inflation data, but the market potentially focusing on this post from the president that you can see right here, indicating that today is the big one when it comes to reciprocal tariffs. Of course, that is something that we are going to be covering here today, Brad.
Absolutely. Well, Bank of America warning the Fed's rate cutting cycle has come to an end following this week's inflation data. And with the threat of additional tariffs, investors are showing concern. And right now, we've got, for more on this, our own Josh Schaefer. Josh, you're taking a look at what BofA's warning is here. What's your read through on what we're hearing across the street?
Yeah, so there was a couple economists out yesterday at Bank of America noting that there's the potential for maybe rate hikes at some point this year. Deutsche Bank also saying that. I think what was interesting from both of the commentaries was both economists saying maybe the CPI data yesterday puts hikes a little bit more on the table than they were, but that's still not the base case. And I think that's an important part of the story here. Market now pricing in one rate cut for this year. One of the reasons we were sort of breaking down yesterday with, well, hot CPI, why did stocks not do as bad as we maybe would have expected? The market still feels like the Fed has an easing bias here, and it seems to be that's been part of the bull case for stocks for 2025. So until we lose that, that's kind of a key linchpin in what's been the bull case for stocks in 2025, right? So overall, still some positivity when you sort of read through there. And I think the other thing we saw yesterday too, which I know you guys are going to get into in a minute here, you had the 10-year shoot up to about 4.66 yesterday, came back down a little bit. We were talking with Michael Kankrowitz from Piper Sandler in the afternoon, and he said that was part of the reason he thought maybe stocks came back a little bit in terms of the afternoon trading session. And then also this morning, Maddie, you brought up PPI a little bit hot, but again, look at that 10-year. Again, that's been one of our key sort of guides to what stocks are doing. 10-year a little bit lower this morning, not really shooting higher off that PPI news. Perhaps it makes sense that stocks also still sort of accepting that overall and not really panicking too much when it comes to a little bit of a hotter read, but maybe the read through for the Fed's preferred inflation gauge PCE also looks relatively okay.
Right. It seemed like the front end of the curve in particular, which tends to move a little bit more off the back of this economic data, was pretty stable following that hotter than expected PPI print this morning. So we were trying to suss that out all together as a team, kind of what's going on. And it seems like under the hood of PPI, some of the more volatile areas of the inflation data were the ones that ticked up, which maybe is an indication that there's not that stickiness to worry about.
Mm-hmm. Yeah, definitely. And I think, so looking at some analysis here from Paul Ashworth over at Capital Economics, he's pointing out that the read through to what is actually sort of the market takeaway usually from PPI would be, what does it mean for PCE, the Fed's core inflation, or the Fed's preferred inflation gauge, core PCE? Not that big of a move there in terms of what we expected from yesterday to today. Remember, when PPI comes out the day after CPI too, and CPI was already hot, you kind of had your reaction maybe a little bit yesterday. And so if you were going to be worried about hot inflation, sticky inflation, that probably was a little bit of a yesterday story. Today, just continuing that narrative a little bit, if not giving a little bit more positive news. But I don't think at this point seeing kind of meh inflation data is a new thing for this market at this point.
Yeah, and so all that in mind, and it was funny, I was reading through the reaction from BlackRock's Rick Reeder on this and saying that running around a track can be frustrating when you realize you haven't gone as far as you thought here. And the description within that, receiving information that's likely to hold an impact on the market's perception of the trajectory of interest rates as well. So you talk about how we've heard commentary from Fed Chair Powell, even in congressional hearings over the past 2 days, and they continue to talk about this 2% target, but getting to that 2% target and then us being there for the long run is really what markets have been a little rattled by, at least during yesterday's trading session, and then we saw a little bit of a rebound during midway of the session as well.
We are close, but we are still far, right, Brad? Yeah. I think when we run around that track, sometimes the finish line feels like you can see it, but I don't know, personally, I get a little bit tired.
Exactly.
Well, we are going to see how the bond market continues to kind of drive the thesis moving forward. Josh, thank you so much for joining us. Appreciate it. That recovery in the bond market, taking a look at that now, coming in a little bit after Treasuries saw their biggest sell-off in 2 months amid that hotter than expected inflation data reading coming in yesterday that pushed out rate cut expectations. Joining us now with more, we've got Blake Gwynn. He's RBC Capital Markets head of U.S. rate strategy. Blake, great to have you on to kind of talk through what's going on when it comes to the Treasury market and the reaction to inflation. What thesis can you derive from both what we saw in the 10-year with the sell-off and then coming in a little bit today?
So I think we came into this print, the CPI print yesterday, kind of expecting a repeat of the seasonality we've seen the last few years. Everybody kind of knew it was going to come in a bit hot. We just didn't know it was going to come in that hot. So I think the fact that we had that sell-off yesterday, clearly it still took a few people by surprise. I think there was this kind of growing narrative just in the week before the print. So it kind of went too far and then pulled back a little bit, where some people are coming out and saying, well, after 2 years of this, the seasonal adjustment factor should be starting to kind of normalize. Maybe it's not going to be as bad this time around. This year is probably a bit softer than the last two. So then when it actually showed a bigger swing from December to January, I think that spooked a few people. That includes the Fed. I mean, we heard from Powell yesterday. He certainly seemed a little bit rattled. He kind of moved his goalpost a bit, saying, I'm focused on those year-over-year numbers.
Right.
But that year-over-year core went from 3.2 to 3.3. Everybody was expecting it to go down to 3.1. So even that wasn't totally fantastic. He did point to PPI today and how that would read through to core PCE, as you guys were discussing. That looks relatively benign at this point. But I would also note that one of the main doves on the committee, Goolsbee, was actually out yesterday saying this was a sobering print on CPI. So if you have a dove kind of taking a bit of a step back and saying it's sobering, certainly means something.
Is it sobering because if we were to see more prints, or at least a trend of prints where you saw the month over month actually usurp or invert against what we have seen in wages, and that having a larger impact on the mindset of the consumer, is that what they're trying to run the calculus around, or at least get ahead of and start the conversation?
Yeah, and I think even if we know that some of this is a mechanical issue around the seasonal adjustment process, optically, it just makes it difficult. And I think, time and again, we've seen, I think the progress the Fed has wanted to see just keeps not quite being there. It's just a little bit ahead, a little bit ahead. And so I think they've just kind of had to continually keep rolling out their time frame of when they're going to get back to that 2% target. But I think what is very true about this print is it makes it very difficult to think about resuming those cuts anytime in the near future. So even if it's mechanical, even if they can kind of write it off and say, well, the pass-through to core PCE is not that bad, it's just very hard to come back with a cut in March and probably even May.
How soon do you think that first cut is?
So we don't have any more cuts. Our forecast, and we've been here for a while, we actually think we're already at the terminal rate. Yeah.
Can we talk about that? Because Powell, to me, the news coming out of Powell's testimony this week is that he sort of teased that the terminal rate might be higher than the market is necessarily pricing in right now. What is it going to take for bond investors to get on board with that? And do you even agree with that idea that the market is not ready for this to be neutral?
Yeah, and I think something notable about what Powell said, it wasn't just that neutral may be higher. He also said we should stay restrictive for now. So it's not just where that setting is. He's saying we should also be beyond that setting for the time being. I think part of our view, we had essentially been calling for a 4 to 4.25 terminal rate for most of last year, and a big piece of that was that we thought the short-run neutral rate, so maybe not the long-run dots that you see in the Fed's, in the Fed's forecasts and things that a lot of these longer-term models would suggest, but the short-run neutral rate for the economy was actually a lot higher than people were expecting, including the Fed. And I think there's a growing awareness of that. I think you've seen a lot more Fed members kind of talking about, well, maybe neutral is this range that extends up to the 4% type of level. So, Yeah, I definitely think they've come to that realization that neutral may be higher.
It makes me wonder if the bond market is getting on board with that idea. I want to throw up a chart from the past 48 hours here that we can take a look at the moves that we've seen in the bond market here. It was interesting seeing the initial reaction on the 10-year. Yields kept climbing even after other maturities started to calm down just a bit. And I wonder if that indicates to you that the market is starting to get on board with the idea that this could be neutral.
Yeah, I mean, I think yesterday was just a bit more of a kind of washout. I mean, certainly, I think the market is coming to terms with that. You see the Fed pricing starting to kind of flatten out. We're taking out remaining cuts. You guys mentioned a few of the calls that are kind of coming more in the direction of where we've been, which is that there's not really cuts coming, and that actually the bias could shift towards hiking by the end of this year. So that's kind of where we've been calling it.
When you think about the Fed's long-run 2% target, do they need to come off of that 2% target, knowing that we have a much different scale versus what we were using 2% as our kind of North Star as in decades prior?
Yeah, we'll see. I mean, Powell was asked about this yesterday. They just started their review process of their framework. So I think a lot of people are looking at that process, wondering if there will be some change to the way they're targeting inflation. They've been using this flexible average inflation targeting scheme. People call it FATE. You've probably heard. So there's some talk about
what new name.
It's pretty tough. It does allow for a lot of puns when we're writing our pieces, but no. I mean, I think we're going to see where that process goes. I think there's a very good chance we could see some minor tweaks, but I don't expect them to come meaningfully off of that 2%. I think there's you can look at some studies throughout the last 20, 30 years that suggest that 2% actually is a pretty decent level. When you go up to 3%, some things start happening that the Fed probably doesn't want to open the door for. So I think they probably stay at 2%, but maybe the way they target 2% changes a bit.
So then, is there a plausible scenario where we could get a hike this year off the back of some of this sticky inflation data?
I think it's certainly plausible. I mean, I think one thing we're watching a lot, obviously we're all talking about tariffs. I think some of the bigger risk to a potential hike is actually coming from the immigration side. Tariffs, I think to some extent, the Fed will look through one-time direct price increases. If you're seeing a pass-through of those tariffs to consumers, they can kind of write that off to some degree. It's something that I don't think is a very good use case for rate hikes to counter because it is coming from tariff policy. So I think the scale back in the labor force, and if we start seeing wage pressure coming from the continued declines in immigration, that could actually be more meaningful for the Fed and could be something that I think is more risk of a hike later this year than even tariffs maybe.
Interesting. Blake, great to have you here in the studio with us this morning. Really appreciate it.
Thank you.
Certainly. Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, we dig into earnings as Deere faces a challenging year. Plus, Robinhood getting a big boost from crypto trading. We've got more of those details ahead on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session. We've got Yahoo Finance's trending tickers page that it'll take you to. First up, let's talk a little Deere. Reporting weak first quarter results with net income falling 50% from a year earlier. Still, that beat analyst expectations. The farm equipment maker maintaining its full year earnings guidance, even as it expects large equipment sales to fall 30% in the U.S. this year. Joining us now, let's bring in Michael Shilsky, who is the D.A. Davidson Managing Director of Equity Research. I want to get your take on these results.
Yes, hi, Brad. I think for us, it seems like most of what Deere's been talking about all along is pretty much coming true. It's going to be a very tough year for its larger equipment, even a down year for its smaller construction business. At the same time, the company is finding ways to manage their cash flow. In this particular quarter, it seems to be because of lower expected tax rates, but they are able to manage their cash flow, and it seems to be unchanged from what they were talking about this past quarter. So while it might not be the greatest year ever, it's certainly not getting worse from what we can tell here.
Walk me through the street's reaction then, because it was interesting, particularly when you take a look at that revenue coming in around $6.8 billion. That is not at the top line of the street's estimates, but far above the street's lowest estimate of around $3 billion. Of course, it's down from last year's revenue, but why do you think that the street is so seemingly disappointed by that revenue number?
It seems like Deere continues to try to reduce its inventories in the dealership channel to position itself for whenever things flatten out or we start to see a upturn. So there's quite a bit of aged inventory apparently at dealerships. At the same time, that's been widely known, but we kind of thought that maybe last quarter they were already through with all this inventory reduction activity. But it appears as though Deere is shipping a lot less to their dealerships in order to make sure that the dealerships have a reasonable amount of inventory and not putting on large discounts to get sales going.
Michael, we've heard for what seems like the better part of 4 quarters, maybe 5, about this artificial intelligence move that we're going to be seeing from John Deere and how that's going to be the next wave of sales into even their existing client base. Are we seeing that play out right now to the extent that was expected? And what really needs to happen in order for that to be the next core catalyst or driver of revenue and growth for this business?
Yeah, I think things are playing out right now in both their autonomous solutions and their AI-driven solutions. On the autonomous side, Deere is ramping up its autonomous product in 2025. This is the first real season where they're more widely going to release autonomous tractors. What could be favorable for Deere in that realm is that it might be tougher for some farms to find labor to get some of the work done going forward due to policy changes at the federal government. Having products that help save on labor costs and on labor hours will certainly become a lot more popular. Cost, of course, is a big factor there, but if it's reasonably priced, I think some farmers will go for it. From an AI standpoint, they are rolling out a lot of subscription products to reduce fertilizer use, to reduce chemical use. They're able to kind of show farmers, hey, we can reduce your fertilizer by 50% or your chemicals by 35%. They're charging a small fee, a small percent of that as their subscription, but net farmers are benefiting. So farmers do typically react when they do see a product that can help them get some additional value. That's certainly happening for Deere. It's slow. It's only a 3% a year growth. It should start to ramp up here in 2025.
I have to end by asking you about any potential tariff impact. Obviously, the president teasing out potential retaliatory tariffs against Deere specifically on the campaign trail if they do not move more of their production stateside when they were considering putting manufacturing in Mexico. How big of a headwind do you think that could be for John Deere moving forward?
Right now, we think it's going to be a net modest headwind. So think of it this way. If we start to have tariffs on products that Deere is exporting or is importing, and there are retaliatory tariffs on products that the U.S. is exporting, such as crops, those buyers are going to try and find their crops elsewhere. It could be from South America, it could be from Europe or somewhere else. The demand for crops globally isn't going to change, so any decline in the need for U.S. crops might be offset by, let's say, Brazil. Will have a much better performance, I think, for farmers in Brazil and higher demand for equipment there. It might not be a net 100% offset, but the impact globally will not be as large as I think some people are expecting.
All right, we got to leave it there, Michael. Thanks so much for joining us. We appreciate it.
Thanks so much.
Another trending ticker we're watching today, Dutch Bros soaring after beating fourth quarter expectations. The coffee chain reporting revenue up 35% year over year. You can see that stock up over 28% right now. The company also issuing a strong full year forecast as it looks to expand mobile ordering and food options. So a huge move ahead of the market open here for this company that Yahoo Finance has been covering for a long time. Our very own Brooke De Palma, a huge deep dive into the company. So if you'd been following us, you would have owned this stock that's been up 112% over the last year here. Some analyst commentary, just taking a look. The street still very bullish on Dutch Bros. It's got 12 buys and only 2 holds on the stock. And you're seeing, again, that top to bottom upside growth in the fourth quarter here. Just quickly want to point out some analyst commentary. Jeff Bernstein over at Barclays saying that there was an upside top to bottom surprise here in a similar manner to the prior quarter, and the consensus is a reflection of positive moves to come, raising his price target. And then TD Cowen also talking about their traffic-driven beat as well. So seeing just bullishness across the board when it comes to some of these numbers here.
Yeah, 2 things for me that I'll add on to this. Shop openings, and then the other thing, net income. We'll start on the latter. Net income, $66.5 million.
Yeah.
What's the comp? $10 million. All right, so checkbox there. And then additionally, take a look at some of these shop openings that they're going to be powering this year compared to what they had already seen in 2024. 2024 was good. They opened 151 new shops, 128 of them company operated across 18 states. And then additionally, take a look at this year and what they're looking to do. Opening estimated at least 160 there. Capital expenditure basis should come somewhere between $240 million to $260 million. So that sounds like a business that's very confident in its ability to enter into new markets. Oh yeah, in the little luxuries category. Who's going to cut out their daily cup of coffee, especially when they're already paying too much for eggs right now? So they're sitting there saying, this is where I can still have a little bit of happiness enjoying my day.
Yeah, and Dutch Bros has been ahead when it comes to implementing AI, cost cutting. So
AI in your coffee?
AI in the coffee. Hey,
we're buying it? All right.
Gotta cut costs somewhere.
Okay.
Yeah.
Finally here, let's talk a little Honda. Honda and Nissan officially ending merger talks that would have created the world's 4th largest automaker based on annual sales in 2024. Yahoo Finance senior autos reporter Pras Subramanian joins us now with more on the implications of this failed deal talks here. Pras, what do we know so far?
Yeah, today they confirmed there was a lot of reporting that this deal was basically coming undone, and now both sides have confirmed that they're mutually ending. So now there's no breakup fee if they both decide to say no to it. But basically, a lot of concern about was Nissan doing enough cost cutting? Would they both be nimble enough as a bigger organization to do things that need to be done quickly as the evolving auto space sort of is upon us? And basically, the last-ditch effort to sort of relegate Nissan as a subsidiary to Honda was not what Nissan was willing to deal with. And even Renault said that they thought that who's a minority owner of Nissan said the deal wasn't enough premium for them. So this deal goes away. The big question now is what's next?
Well, right. That's exactly where I wanted to go with you, Pras, because I have the question of what's next. And also, it seems to me that every time these deals fall through, a couple years later, we're back talking about it again. And these conversations can kind of still come up. Do you anticipate that being a potential what's next, or is it something else?
No. I mean, look, for Nissan, the writing is that they need to actually do something. They can't. It'll be hard for them right now,
to survive without
where they are right now.
Yeah,
it's possible, but it looks like they need a partner, and we've seen Foxconn talking about an investment there to help them build out their EV products. Right. That's a possibility. There's also talk about could Renault and them have a bigger merger. Both sides don't want to do that. I just saw another report that from Bloomberg that KKR is looking around, so there could be a private equity deal or an investment of some sort for Nissan. So maybe that's what happened. But Honda too. Honda, look, they're in great shape, great products. People like them, but they're I think the 8th or 9th biggest automaker. They need scale too, so they can't just sort of sit on their hands either. So I think that's also possibly what happens to Honda. They've had some collaboration with GM and things like that, but haven't really gone beyond that.
And an interesting past year for Honda too. I know that they had published their financial results for what is their 3rd fiscal quarter. Just today they came out with those, and it was in size 10 font. So I didn't get to read all the way through it. But at the end of the day, it looks like year over year, for at least the 9-month period, they had actually seen sales move higher by about 8.9%, so roughly 9% in the sales revenue department, but a little bit of pressure, it seems, at least on the profit for the period, that same comparable 9-month period at least.
In these legacy automakers, it's always going to be an issue with can you get more profit out of these cars? You have massive, vast operations. That's why they need to do the cost sharing with other automakers to make new EVs and new hybrids, right? That's what everyone wants these days in the U.S. And also, I think the big issue with Nissan was China too, and even Honda's. How do you compete in that space when you're dealing with really cutthroat and actually innovative competitors? That's the big issue. Is how do you Honda's doing well in the U.S., right? It's how they perform in Asia.
Especially when that low-cost Civic just goes for so long. I mean, my goodness, I remember taking my sister's car after she went to college, and I needed one when I moved to Maryland.
The new Civic is amazing, by the way.
Is it?
Yeah.
Interesting.
Yeah, it comes as a hybrid. So it's a really good seller, and it's cheap. So that's what we're talking about. Nissan needs some of those cars.
All right, I might be back on the market. Who knows?
I love it. Pras, this is why we bring you on. You have all the car expertise on deal making and models, and we love it. Thank you so much, Pras. Appreciate it. We're going to have all your markets action ahead right here on Yahoo Finance, so stick around. You're watching Morning Brief. Those shares still in the green. We're just about 30 seconds away from your opening bell on Wall Street. So I want to take a look at how the market is doing, trying to get our boards to respond for us here. But it looks like we are holding on to gains in the S&P 500 and the Nasdaq here. The tech-heavy Nasdaq leading those gains here this morning following the back of that inflation data that did surprise to the upside, but not too much of heat when it came to the under-the-hood data there. And that is your opening bell on Wall Street. You got SailPoint ringing the opening bell at the Nasdaq. We're going to be speaking with that company IPOing today. Our very own Brian Sozzi will bring us that conversation here. And I do want to bring us back to the board because I want to see if I can get the market to respond to me here. It's really interesting to see the continuation of moves to the upside in the market following that hotter than expected inflation data this morning. But the market's sloughing that off, and we're seeing that playing out in treasuries as well, which is interesting given the degree of the move that we saw in yields over the past couple of days off the back of that inflation data. It's been interesting to see that kind of coming in. We saw the 10-year hitting as high as 4.6 yesterday, now coming in just a bit this morning. Taking a look at the Nasdaq, the tech-heavy names this morning, we got Tesla leading some of those gains to the upside in the morning trade here, and part of that leading coming in from companies like Cisco, really strong earnings that we're going to be talking about this morning here. You got a lot of names in the Mag 7 in the green this morning, actually. It's about half and half. Interesting to see Meta under some pressure. I want to flip over to show you the 16-day chart because there you can really see the degree of positive gains for Meta. It's on an 18-day winning streak here, so interesting to see it continuing to come off of that in the morning trade. Having said that, of course, we will continue to monitor those moves throughout the day, and I do want to take us back just to take a look at our market moves again as I start to wrap up here because it is interesting to see again those tech-heavy names leading the market into the green this morning, up nearly 0.5%. We're going to get to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Well, thank you, Madison. I just want to point out that we are still in consolidation mode near highs. This is the S&P 500 three-month chart. Yesterday's price action was pretty instructive. We began the day on a red note and we ended in the green, or at least near the green in a lot of the major indices here. Nasdaq finally did close in the green. But here we're looking at a three-month chart of the S&P 500. Continues to consolidate, just looking for that catalyst to break out. It was not the inflation report from yesterday, so we just wait for the next one. Maybe something comes along in earnings season. Maybe we have to wait for something in the jobs front. Nevertheless, let me just move on here. It looks like small caps holding their weight today, and I will move over to the bond market. Here's the 10-year T-note yield. And let me show you a 2-month chart there and see if we can pull that up. Well, let's do a 5-day chart instead. And here we can see we are just down 8 basis points today. That's a pretty big drop. Yesterday we were doing the opposite thing. We were going up, and that was pressuring risk markets just a bit. And today we're moving down. So that's a positive development there. U.S. dollar index, that is also looking to be down net from yesterday, but just a tiny little amount, not meaning too much. And we'll go to the sector action. And let's put the sector action on an intraday look. Consumer discretionary was leading in the early goings this morning. That's retail. That is the desired retail. And then we have materials is actually leading right now. That's XLB up in the upper left. And then kind of trading places with some of the other leaders right there. Energy, the weakest sector today, that's moving 0.5% to the downside. And if we flip over to the Nasdaq 100, as Maddie said, Meta coming off that 18 straight wins. And is it going to be 19 today? Will it be 20 tomorrow? They have been pulling rabbits out of the hat with some late day rallies, and we'll have to see if that can continue today. But I'll give you a 2-month chart in Meta, and let's change that to a 5-day, and you can see up 1.65%. Now that includes a new record high for, I believe, all of those days, and yet that's a relatively small amount. So just tacking on those small gains day after day. And then if we go to the Dow, I got to bring up Cisco. Cisco is up 6% right now. And this is a stock that has not seen the current levels since 2000. It doesn't look like it wants to give me a chart that goes back that far, but our data does. And you'd have to go back to the year 2000 to find a higher price in Cisco. And I guess it just goes to show you that if you hold long enough, things eventually do come back sometimes. But that has been a long, long story there for Cisco. Got to close with some futures here because because we are seeing copper reaccelerate. Now, yesterday we broke that 6-day streak, but we are right back up to highs today, and we can see that we just hit, this is a 4-day chart, but if you go back about 4 months, that's the last time you saw a price this high in copper futures. Ties in with the China story that we've been tracking. So you see a lot of red on your screen today, but still, the advance in commodities is something that I'm tracking here, and I think has a lot of statements to make about the risk market rally this year. Guys?
Jared, thanks so much. Really appreciate it. Teeing up today's session activity. It's time now for today's strategy session. A bearish trade is looming for U.S. stocks, according to Goldman Sachs. Scott Rubner, writing in a note to clients that the market is increasingly crowded and dip buying is running out of steam. Joining us now to discuss the outlook for equities is Empower Chief Investment Strategist Marta Norton. Marta, what say you? Is dip buying actually running out of steam?
Well, dip buying is always something that makes a lot of sense when the market has a trend upward, but of course, dip buying can hurt a lot more when there's a sustained move downward. And I think the largest risks on my mind today feel very pedantic, but I think are pretty meaningful, and it relates to valuation. This feels like something that investors ignore a lot of times, but when we start to get to the extremes that we're seeing today, there's more risk to the downside. And I think you especially see that in areas like technology that carried the market so effectively in 2024. And of course, we're seeing some kind of uneven footing there so far in 2025. And I think that speaks to how stretched things have become.
Marta, I wonder if you can talk to me a little bit about the amount of cash that we have really sitting in United States equities right now, and whether or not that is a potentially bearish signal, just given that a lot of that cash is already sitting stateside. Is that something that you look at?
Well, to some degree, I think so. I mean, I think we want to see investors. I think what's top of mind for us is really the sentiment around expectations for how the equity market is going to behave. And if we start to see, I guess, some capitulation, I think that can move money either into cash or into markets. So I think there is some concern that sentiment could be shifting, especially as we've had 2 years of back-to-back 20% gains. That can mean that if there's some sort of disappointment, investors lose their nerve.
Marta, what are the keys to identifying the trades that are actually going counter the broader market trend here and perhaps still have some of the kind of core thesis around a name that will remain intact regardless of the broader market cycle?
Well, that's a good question. I think there's a few things that you want to have in your corner. I think you do want that valuation element because it speaks to sentiment and allows you some room to have some return to mean. But I also think you want to have some catalysts. And when we're thinking about catalysts this year, of course, one of the key catalysts is related to fiscal policy. When we think about where fiscal policy is really favoring markets, you can think of a lot of small cap areas.
Marta? Okay, we're going to try and get the audio fixed there from Marta. We just had her on a moment ago, breaking down some of the core pillars to identifying a trade that perhaps has more staying power even in the midst of a market downturn, or at least a retracement here for a little bit. It is time now for our chart of the day, which we're going to jump on over to. Let's send it over to Madison Mills, swift on her feet, over at the Wi-Fi Interactive for a look at how active traders are feeling about different sectors right now. Hey, Maddie.
Jumping and moving today. All right, so sectors that active traders are optimistic about. This comes from a survey of investors looking at where we are seeing bullishness in the market. Now, one thing that I was about to ask Marta about that I thought was really interesting is that traders are actually becoming a little bit more bearish than we've seen in the past couple of years. We're seeing bearishness hitting a record high since 2023, but these are the sectors that investors are still bullish about. Despite that, what a huge surprise. Investment in information technology, 75% of those surveyed still feeling optimistic about IT in 2025. Comm services right up there too. That's going to include the likes of Tesla, so that's no surprise. Really interesting, though, to see energy so high here, particularly given some of the movement that we've seen in energy stocks following announcements from the Trump administration on energy policy, the drill baby drill mentality. More supply equals lower prices, but investors are still seeing energy stocks going up. So I'm interested to suss out a little bit more of what investors might be seeing there. If we can flip the board, guys, I do want to take a look at a little bit more of the bearishness. You can say somewhat less optimistic on some other areas of the market. that are a little bit more rate sensitive. So utilities is an area of the market that we've seen just have this record run up, so it's not too surprising to have a little bit of gas taken out of the tank there. Materials, healthcare, and real estate at the bottom. Materials, something that can be heavily impacted by tariffs. Healthcare, I feel like we have consistently been talking to investors and sources about healthcare being an area of growth moving forward, and we just haven't seen it yet. And it is a bit rate sensitive, so seeing a little bit less optimism there. And then, of course, real estate, extremely rate sensitive. We're seeing not only interest rates themselves keeping mortgage rates higher for longer, but also just the moves of the bond market keeping that 10-year higher for longer. Having said that, Treasury Secretary Scott Bessent has been clear that it is his goal and the president's goal to keep a lid on that 10-year yield. So we will see if that coming in a little bit could potentially be a boon for real estate. But right now it does seem that investor optimism in the real estate sector waning just a bit here, Brad.
Maddie, thanks so much. Appreciate it. Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
Robinhood's revenue more than double its most recent quarter after the online trading platform benefited from a surge in activity around the presidential election. Cryptocurrency trading revenue, a particular bright spot around that time, soaring more than 700%. And it's really interesting, Brad, in particular, to see the degree of the move upward in the stock price, up 14% right now, but that's actually coming in a bit from some of the moves we saw earlier this morning. That record revenue doubling is such a huge growth story. My big question is going to be where they go from here.
Yep.
how they deploy some of that capital internally in order to maintain that growth story moving forward.
No, it's a great point. I kind of boiled this down to three things after being able to hop on the phone on a call that Jason Warnick, who is the CFO at Robinhood, had with media, and really kind of laying out some of their own growth trajectories, some of the advancements that they had seen in the most recent quarter and fiscal year as well, which by every measure was a record-breaking quarter and year. That's kind of where I started off my analysis of this. And you really think about where the Q4 revenues moved up 115% year over year. That was a record $1.01 billion here. And within that, if you look further under the hood, what he also gave us is a little bit more color, is there are 9 areas of the business that are all contributing $100 million. That's annualized, I believe. And so all those things considered, this also, and the growth that they have seen, really hinges on how many more kind of gold subscriptions they're able to continue to grow out. That's hitting 2.6 million. That too, a record here, and that is up 86% year over year. And then lastly here, we heard them talk a lot about tokenization, and they discussed this on the earnings call. Vlad Tenev, who we've had on Yahoo Finance several times over the past year, he was talking about this on the earnings call and the tokenization of private assets. And this is something that I don't think we've really got a full handle on how that could be leveraged for investment platforms. And we actually heard Apollo Global's CEO talk about this when we were at Invest, and he was essentially saying, yeah, private assets could be the next major investment vehicle, and it really is the tokenization of some of those private assets or things that don't have traditional securitized elements to them. That is the next major element of opportunity or supreme opportunity they were talking about on the call last night too. So kind of once again opened up my mind and connected the dots between something that we had heard at Yahoo Finance Invest to again something that is connecting with a user base that spans generations. Gen Z, Gen Alpha is like, this is going to be the investment platform that they kind of look to for decades to come. And even those who are close to retirement, they got some love on the call too.
I think it's so well said, Brad, and I'll just quickly add there that private credit is something that I think our audience knows about but doesn't always know how to play.
Yeah. And
if Robinhood can find a way to make private credit investing accessible the way they've made crypto investing accessible, that could be the next big growth story.
Absolutely. Well, we're going to be watching this closely. We've got much more discussion on this. The financial services platform has become so much more than a platform to trade stocks. Over the past few months, Robinhood has unveiled a credit card and spending account and launched a desktop trading platform, plus added features and futures and index options trading. Now it has its sights set on financial advice. CEO Vlad Tenev spoke about Robinhood's advisory ambitions on Wednesday's earnings call.
We see advisory as an enormous opportunity, and we're going to tackle it very, very aggressively. I think we can appeal to customers that may be a little bit older, that have more comprehensive needs, and they love the digital experience of Robinhood, but would love a human advisor.
Joining us now, we've got Chris Whalen, who is the Whalen Global Advisors chairman here. Chris, great to get some time with you once again. Just want to get your read through on what you heard from Robinhood and how they're going to be leaning further into wealth management.
Well, Robinhood was one of the best performing non-bank stocks that I follow in the past year. They've been paying a lot of money for the growth. As you probably know, they were using incentives for their gold members. They've had other incentives out there for IRAs where they match contributions. So I think the question in my mind is, when we get this business to a size where we can kind of pull back a little bit on the incentives and the spend, what does it look like going forward? Can they really go out and compete with the Schwabs and the Ameriprises, who are hyper efficient, and they're also banks? When I look at this stock, it reminds me a lot of SoFi and also Block when they got done with their growth period and we started talking about profitability. They kind of lost their allure. And I think you're going to see the same thing happen here with Hood. As they grow, as they get profitable, and we talk about earnings instead of growth rates, I think it's going to be a different story. Last thing, when I see any of these finance companies that I follow, including EBITDA and other industrial measures of non-GAAP financials in their presentations, I kind of wonder why. EBITDA is not relevant to a financial company. And yet I think a lot of them want to spin themselves as fintech, so they present themselves this way. SoFi does, many of them do.
Well, that's really interesting and important for people to keep in mind as they're kind of monitoring earnings coming in. But I wonder how you're thinking about how Robinhood can be strategic in this time of growth. What do you want to see from them next in order to maintain this growth story?
Well, if you look at the business, what's the biggest growth item? Credit cards. They are currently making a lot of money on their sweep accounts, but they have to give away a lot of that money to the banks that are taking the funds. So I think over time, they're going to have to make a decision. Do we become a bank so we can retain the entire spread? You look, they're paying 4% now for gold member deposits on their sweep program. Repo rates are north of 5. We pay banks well north of 5 in the market for collateral. So I think that over time, they're going to have to become a bank if they want to compete with Charles Schwab. It's just the way it is. This is a vicious business, by the way, competitively. And once they really become large enough to be a threat to some of these firms, you're going to see the competitive environment heat up a lot.
What do you think the probability of Robinhood becoming a bank is and the timeline to that?
It really depends on how they want to play it. There are still some dealers out there that are not banks. Piper, Jeffries, etc. But I think if you look at the asset managers, what I call the asset gatherers in my surveillance group, they're almost all banks. And I think that because of that, they have huge earnings potential on the deposit side. Look at Charles Schwab. They have the lowest deposit rate in the country among large banks. So if they astutely leverage that, they can make a lot of money for their shareholders. I just don't know if Hood really wants to go through all that. It's easier just running a broker-dealer. But the question is, can I compete with Charles Schwab and still be relevant to investors? I wonder if they turn down the spend and the incentives, what does this look like a year from now, even if the top line continues to grow nicely? And I think it will, by the way. These are smart people. But the question is, the asset gatherer market, as I call them, which is led by JP Morgan and BlackRock, this is a tough neighborhood, guys. It really is.
So what does that mean for investors, Chris? In your view, should investors kind of ride the Robinhood rally until they become a bank?
No, I think you want to be out before then, because when you're a bank, you become boring. Look at SoFi. Look at the rest of them that had to make that decision. Block. They've all become really boring. And even though they had a nice run last year, the whole group kind of picked up once Donald Trump won the election. To me, this story has already matured. And now you see Cathie Wood, you see some of the other smart money leaving. It's because we're not in the growth phase anymore. We're in the profitability phase now. And to me, that's not as attractive just for most of these stocks. If you look at them historically, if we laid them all out, going back 5 years, I think you would say you want to be in early and out early.
Interesting. Chris, it was particularly interesting and noteworthy to listen to how much they were talking about acquisitions and what that would mean for growing out the business as well. I know we got to leave things here, but we're going to be continuing to check in with you. Really valuable insights. Thanks so much, Chris.
Thank you. Have a great day, guys.
Certainly, you too. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, AAPL soaring after beating on fourth quarter earnings and providing strong guidance for the first quarter. The AI-driven ad platform is up around 700% over the past year. The CEO announcing the sale of its apps business to focus entirely on the ads business. William Blair is bullish, saying the divestment of the apps division positions the company as a pure play ad platform at a higher margin structure. Citi also bullish, citing guidance and the company's business mix, and Morgan Stanley and JP Morgan both neutral on the stock, but boosted their price targets.
Plus, MGM popping after beating on the top and bottom line in the fourth quarter. Regional operations, a highlight for the casino and entertainment giant, with revenue clocking in at nearly $932 million versus just over $900 million expected. A number of firms listed their price targets and lifted their price targets on the stock. Jefferies citing that resilient regional portfolio and recovery in Macau. China revenues grew 3.7% from last year, bucking the overall trend in China. Barclays calling the Vegas business stable at worst and perhaps even growing.
Bucket. All right, and finally, Cisco rising after boosting its revenue guidance for the full year. Rosenblatt Securities upgrading the stock to buy from neutral on recurring revenue growth driven by AI. Citi raising its price target, saying strong growth in networking orders should boost sales in the second half of the year. JP Morgan also boosted its price target, says the results reinforce improvement in the demand cycle.
That's going to do it for the morning brief. You can join me in the next hour for more analysis on Catalyst. Brad at 11 a.m. for all of your wealth news. Stick around for more. Welcome to Catalyst. I'm Madison Mills. We are 30 minutes into the U.S. trading day. Let's get to the 3 catalysts we are watching this hour. First up, markets continue moving higher despite that hotter than expected inflation data. We'll break down why. Plus, what to expect on the tariff front as President Trump plans to announce reciprocal tariffs today. And Elon Musk telling OpenAI he'll halt his bid for the company if they remain for profit. The latest news from the Altman-Musk saga. We'll break it all down. Both CPI and PPI data this week coming in hotter than Wall Street expected. When it comes to the Fed's preferred inflation gauge, it might not all be bad news. Our next guest crunched the numbers and calculated what to expect for that core PCE, again, the Fed's preferred inflation gauge, and he joins us now with those numbers. Omer Sharif, Inflation Insights President. Omer, thanks for being here. Okay, you calculated it all for us. You're the perfect person for us to speak with this morning. Tell us what we can expect from the Fed's preferred inflation gauge.
Morning. So I actually think we got some good news from the PPI today after a little bit of upside surprise in the CPI yesterday. The CPI printed 0.4, a little hotter than expected. But the good news is that after the PPI today, it looks like the core PCE is probably going to come in right around 0.25. We get a little bit more information tomorrow that'll kind of help us sort of finalize the number. But you're sort of talking about a number that's looking like it might be on the cusp of a 0.2 core. So much better news there. And then from a year-over-year perspective, when we take into account all the kind of revisions we got today and the most recent batch of data, it looks like the core PCE is going to decline from about 2.8% in December to 2.6%. So we're just, continuing to kind of creep our way towards the Fed's 2% target. And then just one final quick note, the super core PCE, which is core services, excluding shelter inflation, was up huge yesterday in the CPI, about almost 0.8. Today, it looks like in the core PC, it'll be far more muted, only around 0.2%. So really a much, much better batch of data this morning for the Fed's preferred indicator.
Let's stick on that supercore number because it is so important to the Federal Reserve. And I, too, was a little bit eye-popped at how big that number was on the inflation print yesterday. Why do you anticipate that coming in so much for PCE moving forward? Why is that services number not going to be as high in PCE?
Yeah, so basically there are just differences in how these indexes are constructed. So, one good example is auto insurance. It was up 2% in the CPI yesterday, but the PCE essentially uses sort of a different data source. So that doesn't really come in as strong, but also the weightings of these items are different within the two indexes. So in the core CPI and in the super core CPI, auto insurance has a pretty hefty weight. In the PCE, it's very small. So there are just very different indexes in terms of construction, the data sources they pull in to calculate the numbers. So it really is kind of an apples to oranges situation. You can't really compare the two. And we knew yesterday when we got to CPI that the PCE supercore wouldn't be as bad because auto insurance just isn't quite the same in the Fed's preferred measure. So it's really the index construction differences that are at play here.
So we've talked about the numbers. Talk to me about the story. What thesis can we derive on the path forward for inflation, given what you are telling us that the Fed's preferred inflation gauge is going to be coming in?
Yeah, so I still think the story that Chair Powell has been telling for the last, let's say, 4, 5, 6 months is still very much in play, which is shelter inflation is continuing to moderate. We saw that yesterday in the CPI data, running around 0.3, still a little bit further to go here. But some of the leading indicators there remain encouraging. And when you think about shelter inflation, it's, in the CPI, it's about 40% of the basket. In the PCE, it's about 20% of the basket. So that is going to continue to slow down as this year progresses. That'll kind of act like a bit of an anchor on the overall core rate and help to bring it lower. So I think that story is very much intact. And the good side of the equation, we got some upside in auto prices yesterday, used cars, but we know from some of the data that that's going to slow down in the next few months. So core goods really, honestly, for the last year and a half have been at pre-COVID type run rates. So we're really just waiting to see the super core services inflation moderate. And I think today's data was a good signal that that's where we're headed. But we've sort of been here before. We still have some wood to chop on the super core. So I think it will still take a few more months of data to convince the Fed that the super core really is, it's kind of the last shoe to drop. And once it does, I think we'll start to make better progress towards that 2%. But overall, I would say that story that Chair Powell has told about disinflation, and being in a good place is still very much intact.
The story does have a new character, though, with the new administration. I want to point to President Trump's post on Truth Social today, talking about today is the big one for reciprocal tariffs, those announcements on reciprocal tariffs expected today. What indicators are you watching to indicate the degree to which tariffs could impact inflation?
So it's interesting because we have a real world example from just a couple of years ago.
Right.
If you think back to February 2018, it's when the first Trump administration launched tariffs on washing machines, and there's a lot of talk about whether that impacted inflation overall, and it didn't really affect the broad numbers because, as you can imagine, washing machines are kind of a very small part of the overall basket of goods and services that consumers purchase. But what we did see at the time was that the tariffs went into effect in February 2018. Between April, May, and June, the cost of washing machines and CPI rose immediately by about 18%, and that initial tariff rate was 20%. So not only did we get a very quick pass-through of the tariffs to consumer prices, it almost was close to 1-for-1 at that time. So a lot of the tariffs, for example, on China right now, half of what we get from China is finished consumer goods. It's stuff that's kind of ready to go on the shelves. So I would anticipate things like furniture, apparel costs, including footwear, some of these things we import from China. We could see that go up in price probably as soon as the March or April CPI. So that's something to watch, is this finished consumer goods data that could be impacted by the tariff, especially on China. If it broadens out, then obviously we're talking about a much larger magnitude. And we could see some of that in the PPI as well, since we'll see what those tariffs on intermediate inputs, how they get passed on through down the chain and ultimately make their way to consumers. So both the PPI and the CPI are going to be important to monitor as we get this new information on these tariffs today.
All right, Omer, thanks so much for joining us.
Thank you.
Treasury yields pulling back a bit as investors digest another hotter than expected inflation print. Here with a look at what history tells us about bonds' next moves, I'm joined by market and data editor and host of Stocks in Translation, Jared Blickery. Hey, Jared.
Thank you, Maddie. We talk a lot about stock seasonality, at least I do, and I like to create stock seasonality maps for the entire year to give us kind of a flavor for when we might see some of the peaks and valleys. And guess what? We can do the same thing with the bond market, and we can do that with TLT. TLT is a 20-plus year iShares bond ETF, and here we are looking at 1 year. This is the median price chart pattern that we see since inception, and this goes all the way back to the early 2000s. 2003, in fact. And what's really interesting about this, and when I do the stock seasonality maps, usually we start over here at the bottom left and we kind of zigzag our way to the upper right. But this is much more of a mean reverting instrument. And in fact, we see some peaks that coincide with roughly the first of the month. So the beginning of the month, we tend to see these peaks. Here's February. We'll skip January. There's March, April, May, June, July, August, September, October. Might not be doing this perfectly, but November, December. It's not perfect, but it's really interesting because if you were to buy bonds, if you wanted to be a bond buyer and you were time agnostic, meaning you don't really care when you get in, the middle of the month would probably be a better time to buy bonds than the beginning or the end of the month. And in fact, now is a time probably when you would be in the very beginning of a short trade. So let me just show you how price action in TLT has evolved this year so far. We're only less than 2 months in, but I'll show you. And I'll trace it over here. This is in green. It's a little bit hard to see, but we already had this big spike up that already coincided with the 1st of February. So this seasonality is already playing out. And what we might expect is a decline into sometime into the middle of February, which arguably we're in right now, and then a rise into March. And it doesn't mean that history has to play out this way once more again, but those are the tendencies, all things being equal. So you can have a catalyst kind of throw a monkey in the wrench and change things, but if we were to revert to history, if things are in equilibrium, this is the tendency. So I'm going to close here with a longer-term look at TLT. This is the year's price action. I'm going to put a max chart on so we can see all the way back to the beginning in 2003. And what's interesting, and we need to keep in mind that bonds are inverse to their yields. So we're seeing bond prices here trend higher over this very long-term time frame. Well, they have reversed that. And in fact, this is a reversal of a trend that began all the way in the 1980s. So I think the bottom line for investors is you probably want to be buying in the middle of the month, and you really want to be biased towards selling if you're a seller at the beginning or the middle of the month. Guys?
All right, Jared, thanks so much. Appreciate it. Coming up, we're taking a look at some of today's top trending tickers, including why one analyst thinks that Reddit's post-earnings tumble could be a buying opportunity. We'll get you that news next. It's now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's look at shares of Reddit. Still moving to the downside, down nearly 1.5% after falling double digits. That fall came after fourth quarter daily active users missed Wall Street's expectations. Reddit cited changes in Google's algorithm for the disappointing results in U.S. users. Global daily active users still increasing 39% from a year ago. For more on this, I want to bring in Josh Beck. He's Raymond James analyst covering Reddit. Josh, your reaction to the results?
Yeah, look, it's been a very active session. At one point, the stock was off 15% in aftermarket trading, and like you said, it's now down a couple of percent. So that's a big change. I think once you unpack the results, certainly there were areas of surprise. Certainly, I don't think investors had expected them to miss on users. This was really related to a Google algorithm change. This happens from time to time. But the other parts of the report were actually extremely positive. So they beat by quite a large margin on international users. This is really because they're translating Reddit, which has always been a native English platform, into other languages. And that's attracting more users. So that was a really important proof point. And then also, they're rolling out a new product on Reddit called Answers. So this works a little bit more like a generative search product. So think about Perplexity or ChatGPT. And the early reception to that product has also been really good. I think it kind of opens up a new avenue for Reddit to kind of be relevant in the AI era and provide a new value to users. So certainly a little bit of a mixed bag, but I think there's a lot to be constructive on. And that's why I think you've seen such a kind of recovery in the shares here.
Right, you really have seen that recovery. I am curious, though, when a company cites a specific issue to kind of excuse their results, I like to fact check them by looking across at other companies and see if others are complaining about the same thing. I haven't heard much about this Google algorithm change, Josh. Should I expect to hear more about it from other companies that you cover in the internet space?
No, I think that's always a great, great best practice, kind of, fact check and cross check. So listening to the other internet platforms, it is a little bit of a different beast. Most of their digital advertising peers, someone like a Pinterest or Meta or Snap, they are really primarily driven by mobile app logged in users and accounts. And that's really what drives their business. With Reddit, it's unique in that certainly is a really important component, and that's actually where they get the majority of the revenue. But they also have a pretty large dependency or linkage with logged out users. So this is kind of the open web. This is you searching on Google and then seeing Reddit results and then going to reddit.com. So they are a little bit unique in that they do have an app that drives a lot of the revenue, but they also are dependent on these logged out users that primarily come from Google. So we really haven't heard this as a talking point throughout earnings, but it makes sense just given Reddit is a little bit of a unique property on the web.
All right, Josh, we got to leave it there. Thank you so much for joining us this morning. Appreciate it.
Thank you.
For some additional trending tickers watching this morning, I'm joined by Yahoo Finance's own Josh Schaefer. Josh, thanks for coming back on set with me. Appreciate it. First up, we are going to talk about Alibaba confirming it will be partnering with Apple to bring AI to iPhones in China. Apple Intelligence launching in the U.S. last fall, but is required to partner with a local company if it wants to bring AI services to China. So they had actually previously partnered with Baidu over the past couple of years, and now it looks like they are switching. One thing that's really interesting under the hood here is that they passed on a partnership with DeepSeek because they said the startup team lacked the manpower and experience to support Apple as such a large customer. So I thought that was interesting. I also want to point out a quote from Joe Tsai, Alibaba's chairman, saying they want to use about Apple. Apple wants to use our AI to power their phones. We feel extremely honored to do business with a great company like Apple, Josh.
Alibaba, the hot AI stock
Yeah.
of 2025. Not sure I had that one on my radar. Stock's up. I'm taking a look now. Year to date, up about 40%, and it's been moving quite a bit on little different.
Year to date.
Yeah, year to date. So in basically a month,
Yeah.
a little over a month and a half here. And it's been interesting because the stock's been moving quite a bit on sort of incremental AI announcements that they're clearly starting to make progress in that AI space. And you brought up DeepSeek, kind of the larger question here being of who can kind of dominate AI in China. And then Maddie, on the flip side of this too, Apple. Interesting move here. I thought it was what caught my eye, a comment from Bank of America analysts saying that Apple, this maybe helps them with sort of developing more interest in China. Yeah. Tim Cook had said on the earnings call that one of the key things that was driving new phones or sales of new phones in different areas was whether or not they have the AI solutions, right? So in order to bring that into China, they need to partner with a company like Alibaba. Of course, sales in China for Apple iPhones have not been great, so maybe this is one of the things that can start to help be a catalyst for Apple in terms of iPhone sales.
We know that domestically consumers in China have been really focused on homegrown names, and so maybe this partnership, to your point, is something that can help boost that idea around consumers. But it's certainly going to be interesting to watch tech executives kind of balance their need to work with China while also trying to be in the White House as often as possible. Then you've got Trump fighting China on tariffs. It's a very interesting love triangle.
Well, and that's something I've been thinking about just with this rally that we've seen in Alibaba stock in general, right? Yeah. The fact that it is obviously a company that is largely pretty much their entire business is China and China e-commerce, right? What does that mean in terms of the current administration? How does that play out in terms of the overall China trade? Because of course it's been a hot tech AI name. Yeah. But there's sort of a different dynamic there than rather than getting into, a Mag 7 stock or one of the other AI stocks we normally talk about.
There are a lot more unknowns, perhaps, moving forward. So certainly something that we will continue to cover. But we also want to get you an IPO that we are watching, SailPoint, set to begin trading today on the Nasdaq. It's a cybersecurity company pricing its IPO at the top of its range, raising $1.38 billion in its sale of 60 million shares, expected to open at $23. SailPoint was acquired by Tom Bravo in 2014 and publicly traded on the New York Stock Exchange from 2017 to 2022. So interesting to see the move over to the Nasdaq, perhaps a push to make this a little bit more of a tech-focused company. We will be speaking with an individual from SailPoint later today, our Brian Sozzi, bringing us that conversation from the Nasdaq. But interesting to see them coming in as a competitor in the cybersecurity space, and I'm interested to see who they potentially knock out in the space.
Yeah, I mean, if you were going to draw up a stock to go public in this market, it feels like it would be right around what SailPoint does, right? In terms of cybersecurity, they're a company that uses AI, they use AI as a service, and they sell it to you. That's the hot stock in this market right now, right? As we sort of move away from the AI infrastructure trade of chips and people that are building out the AI systems into how do I monetize AI and how do I help other people monetize AI, it feels like, to me, the investor pitch for SailPoint is right at that. Which then, Maddie, brings up an interesting, larger question of, okay, if this feels like the perfect kind of stock for this market, how's the stock do over the next 3 months, right? And what does it mean for the IPO market? We know the IPO market starting to loosen up maybe a little bit over the last year, but it has not exactly been a thriving IPO market like we saw in 2021. So I think that will be a key question for investors here is this one of the key companies that can start to maybe unlock that market into 2025? We know plenty of strategists have been saying maybe 2025 into 2026 is when you start to see that IPO unlock a little bit. But if the stocks don't do well once they come public, it's not very enticing for other companies to also go public.
Yeah, it'll be really interesting to see. I think a lot of excitement about this being a potential exit year. I would love to have some more IPOs to cover. I'm sure we all would. So we will see how SailPoint does today. Also, thank you so much, Josh, for joining us. We appreciate it. Our very own Brian Sozzi is speaking with SailPoint CEO Mark McClain at the Nasdaq live at 11:15 a.m. Eastern today, so you won't want to miss that conversation. All your markets action ahead right here on Yahoo Finance, so stick around. You're watching Catalysts. President Trump is set to hold a press conference on reciprocal tariffs on Thursday at 1 p.m. Eastern. In a post on Truth Social, the president teased the announcement, writing, "Today is the big one for reciprocal tariffs." Joining me now to discuss, we've got Brett House, Columbia Business School economics professor and former economist at the International Monetary Fund. Thank you so much for being here with us, Brett. I want to start on these reciprocal tariffs. We are, of course, awaiting that announcement. Given your experience, what do you anticipate those reciprocal tariffs potentially looking like?
Well, given our experience, they could look like a variety of things because the Trump administration moves and shifts its positions very quickly. The reciprocity called out in the name reciprocal tariffs implies that the U.S. will put tariffs on goods at the same rate as is charged by its trading partners with whom it doesn't have free trade agreements in place. And those are generally, for emerging and developing countries, a bit higher than the tariffs that the U.S. charges on incoming goods. The question is whether they will apply on an average basis across all imports from the countries in question, or whether they might be applied on a good-by-good basis at varying rates.
Well, it's interesting because I feel like one way for investors to try and get the answer to that question is to try and lock down exactly what is driving the Trump administration's tariff policies. And I've heard them talk about security, obviously fentanyl, the border, but also increasing revenue, increasing domestic production, and reciprocity, like you said. Is it all the above, or is it one of them? And does that give us more clarity on what they'll look like?
It could be some combination of any of those factors, and it's important to underscore all of those are misunderstandings and misapprehensions of how trade works and how the U.S.'s commercial relationships exist with most of these countries. The United States gains substantially from trade. A trade deficit is not another country ripping off the United States, as the U.S. has implied. And putting these tariffs in place will not eliminate trade deficits. They will simply shift them around and change the source of those deficits, so long as the U.S. continues to invest and consume more than it's saving.
And it's interesting in the context of geopolitical news that we're getting today as well, the potential for peace talks between Russia and Ukraine, for example. And from a markets perspective, we saw the euro really strengthening off the back of that versus when there's a tariffs announcement and obviously we see a weakening happening. Just curious your thoughts as someone who has worked in emerging markets, how you're thinking about the kind of push and pull of the geopolitical and the tariff policy that's going to be happening at the same time. Which of those two is going to potentially drive markets moving forward?
I think the most important asset that's moving on the back of the Trump policy combination is the U.S. dollar. We're going to continue to see a stronger dollar that's going to make it harder for U.S. exporters to gain ground in foreign markets as their goods become more expensive. That higher dollar is being driven by the threat of tariffs, by what are likely to be bigger and sustained federal deficits, and by the fact that the U.S. Fed is going to have a much harder time getting interest rates down, given the policies that the Trump White House is bringing forward.
All right, Brett, we're going to leave it there. Thank you so much for joining us. Appreciate it.
Great to speak with you.
President Trump confirming phone calls with both Russian President Vladimir Putin and Ukrainian President Vladimir Zelensky, saying that peace talks will start immediately to end the war in Ukraine. What would an end to the war mean for investor sentiment and also energy trade? Should we see a lifting of sanctions on Russia? Joining me now to discuss, we've got General Wesley Clark, the chairman and CEO of Wesley K. Clark and Associates. General, great to speak with you. Thanks for making time. Given your experience in negotiations here, what can you tell us about what these negotiations might start to look like here?
Well, I think there's going to be a lot of give and take, and I think the Ukrainians and the Europeans are going to demand to be involved. Obviously, there's going to be some back and forth between the United States and Russia. That's inevitable in this case. The Europeans are going to they're going to step up to this because they know that their security is really on the line here. I think they are heeding what the administration is saying, what Secretary Hegseth said yesterday about the fact that they've got to do more. They've got to take the lead in this in helping Ukraine defend itself. And when I talk to the Ukrainians, of course, they all know what was said yesterday. and they're determined to make it work, and they're determined to protect themselves. So there's a lot of strength in the negotiating position.
Yeah, there certainly is. No, sorry for interrupting there. I just wanted to jump in because it's been interesting hearing Pete Hegseth's comments calling Ukraine joining NATO unrealistic. How do you think that could impact negotiations moving forward?
Well, it would have been better if he hadn't said that publicly. He was, after I'm told, after he went off the camera, the minister said, please keep these comments. Let's talk about it amongst ourselves first before you go public with it. But he did. Okay, it's out there. It's a starting point. It's something that could have been protected, but we got to move on from here. What's done is done.
Okay, well, if what's done is done, then talk to me about the path forward. What's the timeline look like?
I think really the sticking points here are, first of all, how the security force is structured. What is the security guarantee? What's the U.S. role in this? The U.S. has to be the backbone of this. We don't have to have troops on the ground. And it would have been better if it were NATO, but it doesn't have to be NATO. But it does have to have U.S. Intelligence, U.S. logistics, U.S. Air support, and perhaps fire support to back up the European forces that are there. Now, right now, the Europeans really don't have the manpower in uniform to do the mission the way President Zelensky thinks it needs to be done. They don't have 150,000 troops they can put in there and then rotate and stay on the line. So that's got to be worked. And then there's the issue of the sanctions. Are sanctions going to be released against Mr. Putin? Is Europe going to, again, become dependent on Russian oil and gas after what's happened? And then how will that affect the security guarantees for Ukraine? And then there's the 250,000 abducted Ukrainian children. There's reparations. There's war crimes that have been committed. So as you move from a ceasefire into something more permanent, which the administration says we want something that's sustainable, you're going to have to not only stop the fighting, but you're going to have to serve justice. And the fact is that Russia was the aggressor here. This is not two boys on the schoolyard who were swinging at each other and you take them to the principal. This is an aggressive move by Russia. It started a major war, unprovoked, in Europe, and there have to be consequences for that.
I want to talk about the lifting of those sanctions in the context of some news from this morning. Russia offering more LNG to India. India saying they're willing to buy. Coming in potentially with gifts today for the president as Modi is expected to meet with President Trump this afternoon. What can you tell me about what that example I just gave tells you about the path forward for sanctions getting lifted? Is it going to be a slow drip where we see certain countries getting in on Russian gas? Or is it something more that's going to look like more of a groundswell of change?
Well, I think if it's a groundswell change, I think the odds of a sustainable peace are lower. So I think it has to be a very slow drip, drip, drip. In this case, there's always been a ruble-rupee connection for India buying and then reselling Russian hydrocarbons. LNG would be no different. The fact that President Modi is going to meet with President Trump today, I hope that'll be on the agenda. I hope President Trump will use his bargaining leverage to keep it under control, because what we want to do is assure that Mr. Putin isn't incentivized to continue the attack. You know, the danger behind this is the Russian ministries have said, well, you've got to address the underlying conditions. Those underlying conditions of conflict that Russia saw were NATO being present in many different states, not just Ukraine, and also the fact of Ukraine's existence as an independent country. So if those conditions are not met for Russia, maybe that means Russia wants to continue the fight. Maybe a ceasefire would just give Russia the incentive to rearm. And so keeping those sanctions on, dealing with countries like India correctly, and having them help reinforce to de-incentivize Mr. Putin to continue the aggression, that's an important element of all this. President Trump is an able negotiator. Mm-hmm. He's got premier power position in the world. I hope he'll use it.
All right, General, thank you so much for joining us this morning.
Thank you.
As we head to break, let's get a check on those major averages, still moving decidedly into the green here. You've got the Dow moving to the upside, and you've got the S&P 500 up about 0.5%, but then tech-heavy Nasdaq really leading the charge today. It's up about 0.9%. Tesla still leading those gains. We're going to be back with more in a moment here. I actually want to correct that. Nasdaq is up over 1.3%, nearing 1.4% in gains this morning. We'll be right back. Take a look at those major averages again here. Still see a green on your screen. The Dow Jones Industrial Average still moving to the upside. The S&P up over 0.8%, but the tech-heavy Nasdaq leading those gains up about 1.3%. In the S&P 500 here, 9 of the 11 sectors in the green. Consumer discretionary, interestingly, leading the way. That is because Tesla happens to be in that bucket, but also information technology not far behind, the second biggest gainer in the S&P today. Well, the Trump administration is reportedly looking to consolidate bank regulators without going through Congress. According to a report from the Wall Street Journal, President Trump's team is discussing plans to collapse the functions of the FDIC into other regulators. The FDIC was created in response to thousands of bank failures nearly 100 years ago. It insures depositors for certain account types up to $250,000 at more than 4,500 member banks. It also supervises financial institutions for safety and for consumer protection. It's funded by insurance premiums the banks pay. Joining me now to discuss the potential change, Bill Isaac, former FDIC chair. Bill, we always tell people, look for accounts that are FDIC insured. What could a potential consolidation look like and mean for consumers?
Well, I hope that what's been rumored is not going to come to pass. I think it would be a serious mistake to decide to get rid of the FDIC or to merge it into another agency. I do think there can be some reforms made that could make some sense. For example, if I have been proposing that the controller of the currency, the FDIC, and the Federal Reserve, their workforces of examiners be merged into a single agency. That would still leave the Fed outside of that single agency and dealing with monetary policy and so forth. And it would leave the FDIC outside of that consolidated agency, and it would be focused on making sure that the FDIC can handle bank failures. The last thing we want is to have the FDIC and the controller of the currency together and sharing responsibilities for bank failures. That's just inefficient and ineffective and not going to work. I think some consolidation could be called for here, and I wouldn't be opposed to it. But I do think that the FDIC has a very important role as an independent agency responsible for handling bank failures in a very effective and efficient way.
So, Bill, talk to me about that, because supporters here would argue that bank regulation, it's too fragmented. They see some merit in consolidation, just like you just said. What should that consolidation sort of look like in your view without sort of combining these agencies and softening the FDIC as a result?
Well, what I have proposed is that the Federal Reserve get out of bank supervision, and the controller of and the FDIC get out of day-to-day bank supervision, and the controller of the currency be given responsibility for bank supervision for the three agencies. And then the FDIC would maintain responsibility for handling bank failures and taking enforcement actions where banks are not behaving properly. I do think that the FDIC needs enforcement authority and to oversee what the controller of the currency is doing.
If these changes were to go through, how do you think banks would read that, and what would they do in response?
Well, I think if what I described happens, I think the banks would soon learn to live with it, and I don't think it's a big issue and a big problem. I do think that if the FDIC is neutered, i.e., it doesn't have any authority anymore, I think that would be a serious problem, and I do not recommend that.
All right, Bill, we're going to have to leave it there. Thank you so much for joining us today. We appreciate it.
Thank you. Take care.
As we head to break, I want to check in on some of today's biggest earnings movers here. You've got AppLovin still soaring. It's up over 30%, still off the back of their better than expected results. Dutch Bros, similar story, soaring off of their revenue story, really coming in better than expected. Also, foot traffic at their stores was better than expected. That stock is up over 25%. And Robinhood continuing to move to the upside, up over 12%, coming in just a bit. We saw it up over 14% just after the market opened this morning. And lastly here, taking a look at Reddit, actually coming in from the depth of its losses. We saw double-digit losses earlier in the trade following their worse than expected results on daily active users in the United States, coming in a bit this morning, down just about 4%. We'll cover more of the moves that you need to know ahead. Keep it here on Catalysts.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Let's take a look at the major average here. The averages here, the Dow still moving to the upside. You got the S&P 500 up about 0.6%. Tech-heavy Nasdaq still leading the charge of the day, up over 1%. It's interesting to see stocks rebounding following that inflation-related sell-off yesterday. We got that hotter than expected inflation data. Today, we got inflation data that was not as bad as anticipated, and you can see stocks moving to the upside off of that news, and a little bit of good company news as well, and tech-heavy names off of those Cisco earnings. Still seeing Tesla, the biggest gainer in the Nasdaq today. Speaking of Tesla, Elon Musk says he will drop his bid to purchase OpenAI for $97.4 billion if the nonprofit stops its pivot to a for-profit model. Here with the latest, we've got our very own Alexis Keenan. And Alexis, it's interesting. We obviously learned about this through a court filing on Wednesday, I believe. Talk to me about what we know about this and Musk's kind of goals for OpenAI right now.
Yeah, so it was back on Monday when we first learned about this $97.4 and change billion offer. It's Musk and a group of investors that he put together to make this offer, put it on the table to buy the assets of the nonprofit OpenAI. Now, this ultimatum, though, it comes in a legal filing yesterday where Musk is saying, well, I will drop this offer if OpenAI and its board agree to go back to the nonprofit mission, which essentially is to develop ethical AI, if you try to kind of put it simply. Now, on X, though, Altman said no thank you that same day. And Musk claims, though, that Altman, by going it alone and unilaterally rejecting that offer, that he went against his fiduciary duty to the nonprofit, that he needed to go to the board to get approval to accept or reject this offer. So Altman, for his part, responded also in another court filing, and he and the defendant say that really that Musk's bid, going with a group of investors that are for-profit folks, that it cuts against the underlying arguments in his case, trying to keep OpenAI a nonprofit. So if you look, though, at that $97 billion offer, it is significantly lower than what we've been hearing. Multiple reports of SoftBank injecting capital into this company, bringing its valuation to somewhere between $260 to $300 billion. But legal experts who I talked to say, well, that may set a price floor, which is important here because OpenAI, the nonprofit, it is required by law to get fair market value for the assets that it owns. And of course, if you're OpenAI, if you are its investors, if you are Microsoft, your incentive right is to keep that number low and buy low. So this kind of complicates the deal, and it's just a $97 billion offer at this point. In a hearing last week, too, in Musk's case, the judge said no matter what, that this case is going to trial on at least some of the claims, because at the heart of Musk's claims are that there was a deal in the beginning. Musk is a co-founder of OpenAI, put $45 million into the nonprofit, and he said the deal was that it remain a nonprofit, and the judge says, we don't know the answer to that question, and we're going to have evidence, we're going to find out, so at a minimum, a jury is going to hear what these parties have to say.
I'm really curious, based on your experience in this sector, how likely is it that we get a definitive answer to that question of whether or not there was a deal at the beginning that OpenAI stay a nonprofit forever?
So we might, right? The parties are still in a discovery stage. They're exchanging documents. We have to see what transpired. What can Musk and Altman prove as to what they said about Musk's $45 million going into it? Even regardless of the $45 million, did they have some agreement at all that this was going to remain a nonprofit? And by the way, the agreement does not have to necessarily be in writing. The judge was skeptical. She said, well, $45 million, that's a lot of money to put on the table without some sort of memorialization of that agreement. But she said, look, oral agreements are enforceable too, so we need to find out what really transpired between these two parties.
A great reminder to keep it all in writing.
Keep it in writing.
Keep it in writing.
You learned it here on Yahoo Finance.
All right, Alexis, thank you as always. Really appreciate it. Thank you so much. We're going to do a quick check on where SailPoint is indicated to open. That stock is set to begin trading shortly here. Again, you can see on your screen here, you've got that share price expected to open around $23. You've already got 60 million in shares that are expected to already be sold here. You can also stay tuned for an interview with Mark McClain. He is SailPoint's CEO. He'll be here on Yahoo Finance at 11 a.m. Eastern Time, joining our very own Brian Sozzi from the floor of the Nasdaq, as this company again is set to start trading today. 60 million shares from that company set to IPO. Coming up here, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you for the next hour, so keep it here on Yahoo Finance for more.
It's time for Yahoo Finance's Market Minute. Stocks are higher as investors shake off another hot inflation print. Robinhood shares are jumping as a 700% spike in crypto trading boosted earnings in its fourth quarter. Company reported $1 billion in revenue for the first time ever. Shares of AppLovin soaring after reporting revenue up 44% from the year prior, driven by a surge in its advertising business. Company also announced the sale of its mobile gaming division to an unnamed private company for $900 million. And Trade Desk shares getting pummeled. It's after its earnings and guidance missed expectations for the first time in years. Oppenheimer analysts say they attribute that miss to a, quote, lack of oversight and decision making. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. And on today's show, Portfolio Checkup. We're going to talk about the most important themes emerging this earnings season and what they mean for your investments. And the state of the labor market. We'll discuss the latest jobs data and talk to a senior economist from Glassdoor about some troubling trends that we're keeping tabs on. Plus, tariff trickle down. We do a deep dive into how President Trump's potential tariff policies could impact the price of a single can of beer. All that and much more coming up. But first, we take a look at some of the market action. We're 90 minutes into trading here on the day. Stocks rising as investors look to shake off tariff and inflation concerns and digest more earnings reports that have come out this morning and yesterday after the close. Joining me now, we've got Thomas Martin, Global Alt Investments Senior Portfolio Manager. Great to have you here with us. About 70% of S&P 500 companies, they have reported quarterly results so far this earnings season. So I would love to get the top themes that you see emerging and perhaps carrying some of the trend later throughout this year.
Yeah, well, thanks for having me on your program. And so far, you know, we're reporting fourth quarter, and so you get numbers for that. But everybody's eyes are on what's going to happen in the first quarter, and of course next year or this year, 2025. But interestingly, there's a little bit of a bifurcation in that the fourth quarter is coming in better than expected, and that means that the growth of the fourth quarter year over year is even better than folks expected it was. The expectation, however, for 2025 was that we were going to get earnings growth in the S&P of, you know, around 15% or so. But guidance has been lowered for FY25 just in the aggregate. And so you've seen that growth rate slip from what was about 15% to down in the 13% area. May not sound like much, but any slippage in the growth rate is potentially risky. Now, we haven't really seen it play through in the market, but those are the themes. And of course, those companies that are beating and guiding ahead with an kind of a guide to sustainably being able to continue their growth, those are the ones that are doing well. And the others, as you mentioned earlier, are being punished.
And so with this in mind, and I'm glad you bring in some of the revisions here, what do some of the earnings guidance and the revisions that we've seen come through ultimately mean for investors' portfolios and any recalibration that they should be considering?
Well, you're seeing a little bit of a broadening out. You know, the Mag 7 is flattening. Some of them are doing better than others. You know, you have Microsoft and Google and Tesla and Nvidia, Apple. They've been sort of used as maybe a source of funds, you know, while companies like Meta have been kind of powering on ahead. So, you know, making sure that you have the right exposure to those names is important, but also as the earnings coming in to making sure that you have exposure to the names that have sustainability and start to lighten up in those that are showing maybe some signs of some issues, whether it's an execution issue or a demand issue.
And so with that in mind, as we're thinking about some of the picks that we're starting to see emerge, because it seems like a stock picker's mentality, even as some of the trend has kind of moved lower broad markets basis in recent weeks, or at least kind of just been range bound. All that in mind, how can you identify names that can continue to outperform even if the market itself is range bound?
Yeah, well, we tend to focus on earnings, and we're looking at those the forward earnings, and that's estimates. So estimates for 2025 are now really at the forefront. Switched over from 24, and we're looking for those where the estimates are going up, and that it's being driven by something sustainable. And so what you're seeing in the market is that companies are being rewarded for maintaining those estimates, and then for having an expanding total addressable market, growth in their revenues, and being able to expand their margins. So we're looking for that, and for that to be sustainable, and looking for new markets that these companies are taking advantage of.
And then just lastly, while we have you here, some of the picks that you're looking at, and I notice a few of these tickers, but would love to dive into just what your takes are on them. You've got Vertiv, I believe. You've also got Royal Caribbean, Freshpet, I believe, as well. And AppLovin is also in there?
Yeah, so I picked those because there's a little bit of diversity in there. Caribbean is just sort of chugging along. They have a lot of good underlying fundamentals with the consumer and the value proposition they have. And the stock has behaved reasonably. It's going up. Freshpet is one of those stocks, along with, let's just say with AppLovin and some of these other high-flying companies that were up strong last year. Vertiv is in that category. But Freshpet, which isn't going to report until the 20th of this month, had, some question about how they were going to guide at the conference where they're going to be announcing their earnings, and that they were going to guide conservatively for 25. And the stock is off 20% from its high. Now, granted, it was a strong performer in 2024, but you're getting an opportunity here to buy a company that has a lot of ways to grow their earnings on the revenue line with their customers in terms of their margins. So I wanted to highlight that one as one that's off a bit. Vertiv reported the other day and was down a good bit. They beat on all metrics except their orders were flat. But it wasn't being driven by a long-term kind of issue. It was more of a short-term dislocation. But the stock got hit off 10% or so, 8%, and that gives an opportunity to buy another one that had been up, as much as 100% last year. Finally, AppLovin, which just reported last night, has already been up 700% last year, but it's one of those companies that is on the forefront of changing its total addressable market, which is growing rapidly and growing into new products and using artificial intelligence to be able to serve its clients better and more efficiently, and to actually potentially maybe reduce its own headcount. So no surprise that that one's up as strongly as it is today, but still has further to go in our view.
All right, yeah, a lot of movement that we've been tracking with AppLovin here today, especially off of some of the latest results from the company. Thomas, thanks so much for taking the time here with us. Appreciate it.
Great, thank you.
Certainly. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Crocs, soaring on a better than expected profit outlook for the full year. The footwear brand sees adjusted earnings per share at $12.70 to $13.15. That is above the $12.58 that was expected here. The company also beating on the top and bottom line in Q4, seeing 4% revenue growth and an acceleration from the third quarter out of China. Crocs upsizing their share buyback plan by $1 billion as well. Next up, tracking shares of Yeti. They're reversing course, trading lower now. The drinkware company did report a fourth quarter profit beat, the upper end of the company's full year profit outlook beating expectations. And Yeti does see adjusted operating margin expansion in 2025, but also see some FX headwinds with its growing international business. Baird is bullish on the stock here, saying that strong free cash flow and buybacks underscore Yeti's considerable financial strength amid ongoing macro challenges in the U.S. And next up here, we're also tracking Hertz falling on a worse than expected earnings report as investors monitor an earnings per share loss and grade the EV sales plan. Now, the rental car company reported a net loss of $2.9 billion in 2024, losing $1.18 per share on an adjusted basis in the fourth quarter. The company has finished selling 30,000 electric vehicles as part of an effort to mitigate losses. The EV fleet was challenged by high depreciation, particularly with its Teslas. They also saw high maintenance costs and issues with charging infrastructure. The CEO saying in a statement that 2024 was about stabilizing the business and 2025 will be about executing a transformation. Initial jobless claims, that is the number of Americans filing new applications for unemployment, fell last week in a sign of stability for the labor market. While claims have been trending lower to start this year, Americans aren't necessarily feeling good about the state of the labor market, thanks in part to slower hiring. Daniel Zhao, who is the Glassdoor senior economist, joins me now to discuss this. Daniel, always a pleasure to get some of your insights on this. Just want to get your read through on what we've seen through jobless claims and the slower pace of hiring on the other end.
Well, jobless claims on an initial basis are relatively healthy. They're similar to where we've seen them in past years, but we do see that continuing claims is a little bit higher compared to where it was last year at this point. And I think that's consistent with what we've seen overall with the job market, where there's been this gradual cooling, there's been this gradual slowing down, and that's something we see in other data points as well, whether you're talking about JOLTS or the jobs report as well. And ultimately, this comes back to sluggish hiring. You know, even though layoffs might not necessarily be elevated on an economy-wide basis, clearly folks are finding it harder to get back into a job after being laid off, and I think that's what's keeping continuing claims elevated.
And so with this in mind, as we're thinking about some of the companies making the largest big cuts here, Meta, Chevron, Estee Lauder, among the companies who've recently announced some of those major reductions to their staff. What does the data tell us about layoffs so far this year versus how employees are feeling?
Mm-hmm. So we have seen that layoffs, especially in the JOLTS data, has trended upwards basically since around mid-2024. They're roughly in line with where they were before the pandemic, after spending much of the pandemic recovery well below where they were prior. But of course, it's important to remember that the average pre-pandemic was 1.8 million people being laid off on a monthly basis. And that's an enormous number. And that means that a lot of these headlines about companies initiating layoffs of thousands of employees, that actually doesn't really tend to move the overall number, because a lot of these layoffs are happening at some of these smaller companies, maybe some local businesses that are shutting down, but they don't get quite the same level of attention. But that being said, when we look at how employees feel about layoffs, what we're seeing is that there's an increasing amount of employee anxiety about layoffs on Glassdoor. So for example, the share of reviews on Glassdoor that mention layoffs is up 5% month over month in January, and that's up 2% year over year. So we're definitely seeing a modest increase in how anxious that workers are about the prospect of layoffs and about the state of the current job market.
Yeah, and that kind of mirrored by some of the data that we've seen from the Conference Board in recent weeks as well, saying that 33% of the consumers in the present situation, at least conditions, they were saying that jobs were plentiful, but that was down from 37.1% in December. So that month over month decrease here is certainly noteworthy. I wonder what you're seeing in terms of the places that are still hiring, the sectors where there is still a need for additions to their workforce.
Mm-hmm. Yeah, so what we've seen over the last year or so is that industries like healthcare, or government, education, like these less cyclical sectors have really been the ones that have powered jobs growth. And so those are probably the places to be looking if you're a job seeker right now. Of course, there are some other factors that are impacting government and education hiring right now, but healthcare continues to be an industry that is growing. It's an industry that tends not to really be affected by business cycles in the same way that tech or professional business services might be. And I think it's always a useful reminder to folks that healthcare employers aren't just hiring nurses and doctors. They need IT staff, for example. They need accountants. And on top of that, there are also a lot of companies that serve the healthcare sector. And so those might be companies to look at that are still growing in the current state of the economy.
You alluded to what's at play within the government side of the employment situation right now, and whether that is some of the buyouts that have been offered and the severance, extended severance, just the amount of workers that could be coming out of the government sector and looking for jobs in the private sector. How do you kind of estimate or run the calculus around kind of that conjunction or that crossroads that we could see in addition to the existing private sector employees that are now looking for work?
I think, unfortunately, it's just a really tough question to answer because there's still a lot of uncertainty about how these moves are going to play out, what gets challenged in court, what ends up getting implemented, and on what timeline as well, right? So it's very difficult to project what the impact will be. If it's a sudden wave versus a gradual kind of a trickle, that can have a very different impact on the economy. And then I think it's also important to recognize that there are also some spillover effects as well, right? Because it's not just about people who are directly employed by the government, but it's also about organizations that get grants or funding from the government or help support these services, right? And so there's a lot of potential impacts beyond that. But it also makes it very difficult to predict what some of these kind of cascading impacts might be.
Daniel, great to see you. Thanks so much for taking the time here with us today. Really appreciate it.
Thanks for having me.
Coming up, everyone, we're sending it on over to Yahoo Finance's Brian Sozzi live from the Nasdaq with the SailPoint CEO and founder, Mark McClain. They'll talk about the company's IPO and what investors need to know about the outlook for public offerings in 2025. That's next on Wealth.
Welcome back to Yahoo Finance. I'm Yahoo Finance Executive Editor Brian Sozzi at the Nasdaq in Times Square. The first big IPO of the year is out of the block for the most part. That is SailPoint. You can see the crowds behind me waiting for that stock to open for the first time. At the desk here with me is SailPoint founder and CEO Mark McClain. Good to see you. The stock hasn't even opened yet. It feels like you should be back there watching the screens, Mark.
I think I could be very helpful, Brian, but they told me better to come over here and do the interview. Stay away from the desk.
So it sounds looking where the stock priced the night before, demand seems strong. So when you're out on that roadshow, I felt as though a lot of people knew your story. You have been public before. You were taken private a couple years ago. What did you hear from investors?
A number of things. We were off the market for about 2.5 years. Very unusual story, Brian. We were talking off camera about, we were owned by a PE firm, Thoma Bravo, before our first IPO in 2017. Ran for 4-ish years, private for these last 2.5 and coming back. But as you said, the market was somewhat familiar with SailPoint. And I think the pleasant thing for all those investors on the roadshow was, wow, we weren't expecting this when you came back. We'd grown very nicely, compounded over 30% the last few years. We'd moved from basically break even to about 15-odd%, 14% non-GAAP profitable. And as you know, what the market seems to be hungry for today is what we call, growth at scale with profitability, right? If you've built a pretty large business, you're able to grow that business and do so profitably. That's kind of the magic combo today. And we were that profile. I think they found that interesting. I'd say the other thing, Brian, in our particular space of identity security, it's called, that landscape's been moving pretty rapidly. And as a lot of folks are familiar with this concept of AI and agents, particularly this idea that these little pieces of technology are going to be running around.
We're all going to be robots, Mark.
We're all going to be. I am actually an avatar. I'm actually an avatar.
It's good to hear.
Yeah, are you?
It fits the investment thesis for your company.
It does. Bet on avatars. That's what everybody tells me. But I think where we are is people have figured out that, as we like to say, identity is the attack vector of choice, right? What the bad actors are doing more and more is, sure, they're going to try to break through your firewall, but they really want to compromise identity, use that compromised identity to get to data. And our systems basically help enterprises protect against that. So it's viewed as a very high value offering, I think, these days.
So compared to when you went private, 2022?
22, that's correct.
What's the biggest change in the company that you have been able to drive out of the eyes of public markets?
It's a great question. I like to, in some ways, focus on the things that didn't change. I like to say, being through the multiple ownership structures we have, we were venture-backed, PE-backed, public, PE-backed, about to go public. The thing I tell our team is what we can control and focus on is how we show up for customers, the products we deliver, the way we get those to market, taking care of those customers as they implement our products and get successful. And I try to get the team focused on that. When we did the first IPO, off cuff one day, I said, look, every second you spend looking at the stock price, you're doing nothing to help the stock price. If you're an employee, stop watching the ticker, do our job, we'll get the stock to go the right place. And so we've always had that mindset. I think the things we did that were probably notable, we did a significant back office IT transformation, the kind of thing that's way easier to do when you're off the market. We shifted our fiscal year end. We shifted some of our spend around the world for lower cost engineering while keeping a lot of it in the US where we're still getting great talent. So there were some moves that could have theoretically been done in the public eye. It was just simpler and faster and easier to do some of those that way.
I talked to a lot of private company CEOs, and they have told me the past few years, we're not coming public because the regulatory backdrop sucks. It's really burdensome. Now that you're about to be a public company, I should mention, stock's still not open. Are you hopeful that the Trump administration rolls back regulations? And how much easier do you think it will be?
Such a good question. I think we learned to just incorporate the regulatory environment as part of the, quote, cost of doing business in the public realm. And as you say, I think we're all watching this unfold with our friend Mr. Musk and Doge and all of that. But there's generally a sense that we're going to move to a less regulatory-oriented administration now. I don't think it's going to all go away, of course, but I think the idea that business will be a little freer to run without as much focus from the regulators on that probably sets up a better backdrop. But it wasn't a huge burden for us. And part of our software deals with compliance and regulatory compliance related to security. So we always say regulation's a double-edged sword for us. We didn't love some of the pain of it as a company in public eye, but because our customers are subject to regulation, it helps drive some of our business.
Well, do you think that we do not get AI regulation under this administration, and a business like yours can run free and do what you need to do?
I don't think we're going to get the level we might have gotten in a different administration. I doubt we're going to get zero, because I think everyone is aware that there are some risks and concerns here that might need to be be addressed. And we're a very global business. We operate in 60 countries, customers all over the world. Even if the U.S. is a little less oriented in that, we've seen the European Union be pretty focused on things like this in the past. I doubt that's going to change. So we're expecting to have to deal with some level of that. And again, double-edged sword. For us, it'll be a little bit of a burden, but it also creates challenges for our customers, which we can then help them address.
Lastly, first time you went public, listed on New York Stock Exchange. Now you're at the Nasdaq. Why?
It's a great question. We're very big fans of both. I think, when we were a young company, much smaller, coming to public the first time, because our target has always been enterprise customers, we thought there was sort of a credibility with the NYSE. Look, we're a big, it's real company. As a tech company, high growth tech company, in some ways the Nasdaq seems to be the place where a lot of those kinds of issuances are happening. Felt like the right time. Both firms run really great shops, but this felt like the right decision for this time.
All right, congrats on the re-debut. Is that fair to re-debut?
It's funny that I in the IPO, initial. I said to the team, why are we calling it a IPO? It's not the initial. I'm confused.
All right, well, good to see you. Congrats on the, I'll call it re-debut. SellPoint founder and CEO Mark McClain waiting for his stock to open for the first time. You can track SellPoint on the Yahoo Finance platform. Ticker symbol what? SAIL?
SAIL.
Simple to remember. We'll be right back.
Thank you, Brian.
President Trump is set to announce new reciprocal tariffs against countries that place higher duties on American goods. This move could escalate his trade war with economic partners. The president is already ordering a 25% tariff on all steel and aluminum imports from all countries to begin in March. Canada and Mexico are among the top steel exporters to the U.S. This is a move that could have big consequences in the auto industry and could even affect the price consumers pay for their auto insurance. Motor vehicle insurance costs are already up nearly 12% in January from the year prior. That's according to the Bureau of Labor Statistics. Here with more, we've got Bob Passmore, who is the Vice President of the American Property Casualty Insurance Association. Good to have you here with us. Just help us dive into this. How much potential of a move higher could we see on the back of the tariffs and impacting consumers in one of the already sticky areas of inflation?
Well, currently about 6 of every 10 auto replacement parts used in auto repairs in the U.S. are imported from Mexico, Canada, and China. And if parts become more expensive, then car owners are going to be paying more each time they need something fixed. And that's also going to impact the cost of auto insurance.
And so with that in mind, as you think about the people who are trying to figure out how they can make sure that they are finding the right insurance that helps them, I guess, offset some of what they're going to naturally have to spend, what are some of the tips that you have for people looking for the best auto insurance rate that they can find, and what can they do?
Oh, well, the best thing to do is shop around. Every company has its own way of setting its prices and its strategy for competing with other carriers. So the best way to find the best deal is to go out and look for it. It's never been easier to do that. You can do it online. You can do it. You can do it in mobile apps. You can do it over the phone. You can do it with an agent. And it's always best to do that every couple of years, particularly when you've had something change, like you're adding a vehicle to your policy, or you got married, and this might seem counterintuitive, when you're adding a teen driver to the policy. Every company takes a little bit different approach on how they price for teen drivers. So shopping around, at least every 2 years, and definitely when you're having some sort of change. Also, take a look at your coverages and deductibles. Deductible, there's a lot more smaller losses than big losses. So the first dollars of insurance are always the most expensive. So if you can increase your deductible, you can save a lot of money there. And take a look at your coverages too. If you have an older car and maybe it's not a real, you might look at your comprehensive and your collision coverage. Do you still need to carry it? Understand though that if you get into an accident, you'll have to bear the cost of either repairing or replacing it yourself. And another place, if you bought a newer car, you might have bought something called gap insurance to cover the difference between what you owe on the car and what the car was actually worth. If you've had it for a couple of years and you've check to see how much is still outstanding on your loan compared to the value of the vehicle, you may or may not still need that gap insurance. So those are kind of things you can do too. And finally, take a look at usage-based insurance or a telematics auto policy. What this is most insurers have some kind of a program where you can either use a cell phone app or a device that plugs into your car, and it tracks how you drive. Usually you get a discount just for signing up, and you can earn a higher discount based on how you drive. And probably the best thing about it is that it gives you real-time driving feedback on how you actually drive. And I know from personal experience, I was surprised at some of the things that have picked up on me, and I've been able to improve in those areas. So you can, those are a good opportunity too, particularly if you've got a teen driver coming onto your policy.
Bob, I'm so glad you mentioned that, because that was one of my final questions here, which is we've heard for the better part of a decade now that, hey, the cars are becoming essentially computers on wheels. You should be able to track more of that data and then leverage that data to actually get a lower insurance rate here. Right. What are we seeing in application? Are more drivers doing this actively? And what steps would you like to see more drivers take in order to get a lower insurance rate because of that data?
Well, it's a great tool both for saving on your insurance and for becoming a better driver, because you get that real-time feedback. People have, usage-based insurance was sort of predicted as the next big thing in auto insurance for the past 15 years. But starting with the pandemic, when people started to drive less, people started to look at usage-based insurance a little bit differently. It's they say, well, I'm driving less, so maybe maybe I am willing to have my driving tracked. And so more and more people have been doing that. It's still not the majority of policies held by U.S. drivers, but it's certainly growing at a much faster rate than it had been.
Bob, thanks so much for taking the time here with us today. Really appreciate it. Bob Passmore.
Oh, you're welcome.
President Donald Trump is announcing reciprocal tariffs this afternoon. This means the U.S. would put the same levies on imported goods that other countries impose on the U.S. And so far, Trump has imposed an additional 10% tariff on all Chinese imports, 25% tariffs on aluminum and steel. And he has proposed and then delayed 25% tariffs on Canada and Mexico. If the countries don't reach an agreement by March 1st, those tariffs will likely go into effect. So, what could all of this mean for the things that we buy every day? Well, one of America's favorite beverages could be hit hard if all these tariffs came into effect. The top sold beer in the U.S. Here to break down the potential impact is Catalyst co-host Madison Mills. Hey, Maddie.
Hey, Brad. So there are three main tariffs that could affect beer prices. Tariffs on aluminum, the beer itself, and energy. So for an example, let's take a look at a beer that is imported from Mexico, and that is Modelo, one of Constellation Brands' most popular products. One of Modelo's selling points is that it's a Mexican beer. So unlike U.S. beers, Modelo is fully produced, canned, and even packaged in Mexico before it's imported. So for a can of Modelo, the full product is tariffed, as opposed to just a specific component of the product. If the beer was produced in the U.S., then just the aluminum from that can would be taxed. But for Modelo, that's not going to be the case. Regarding aluminum tariffs, sources tell me there will now be this mad dash where companies rush to stockpile their aluminum before tariffs are put in place. Stockpiling is a way to kind of buy time in case tariffs do end up being a little bit more short-lived. You don't want to invest in a new product that you may not need if tariffs end up being negotiated away. And lastly here, there is energy, this potential 10% tariff on oil that could lead to increased costs for deliveries for companies here. This leaves Constellation with a choice: eat the cost, pass it on to consumers. But Constellation Brands may not want to do that. An analyst I spoke with tells me that Constellation has been winning against other beer brands, and Modelo is one of the only growing beer brands in the country right now. And you can see, if we have this stock chart behind me, a huge outperformance of Constellation when compared to Anheuser-Busch, of course, the producer of America's favorite light lager, Bud Light. So you can certainly see in that outperformance that perhaps Constellation via Modelo, they may be hesitant to pass on those costs to consumers by lifting their prices.
Maddie, thanks so much. We're going to be tracking this very closely, as we know you will be too. Thanks so. All right, coming up, the future of the FDIC. What potential changes under President Trump could mean for you? That's next on Well. The Trump administration is reportedly eyeing bank regulation consolidation. According to a report from the Wall Street Journal, President Trump's team is discussing plans to collapse the functions of the FDIC into other regulators. Now, this comes after the Elon Musk-led DOJ and newly acting CFPB head Russell Vought temporarily closed CFPB headquarters and ordered a work stoppage. Here with more, we've got Kendall Garrison, who's the president and CEO of Amplify Credit Union, a private fee-free banking and lending services firm based in Texas here. Good to have you here with us, Kendall, and thanks for taking the time. First, what would this ultimately mean if we were to see some of those duties passed on to other regulatory entities?
Well, I think it's interesting because CFPB was really founded in the aftermath of the housing crisis and really built regulations around bringing financial institutions over $10 billion in assets under control and a stronger regulatory regime, which was really needed. I think the housing crisis really proved that very large for-profit financial institutions don't have a great track record of controlling themselves, regulating themselves, and operating in the public interest. And so many of the duties of oversight from the FDIC, the Office of the Comptroller of the Currency, really transferred into CFPB in the aftermath of the housing crisis. And so as we see CFPB begin to wind down and its future become very, very uncertain, many of us in the financial services industry are really looking around trying to figure out what is the next step? What does the regulatory environment look like for us going forward?
And so does that spell out another, and especially as we're thinking about the housing situation right now, we're facing an affordability crisis where, people are trying to make sure that they're going to have the means long term to continue to pay down mortgages and getting approval as well for historically high prices on average for homes. So combine what we're seeing in the housing market right now with the CFPB perhaps delegation of responsibilities to other entities and how that could potentially put us back in the same position as before.
Well, here's what financial markets don't like. Financial markets don't like uncertainty. We've seen bond prices or bond yields rise just in the last several days as the threat of tariffs have come into play. We've seen bond yields rise as inflation is proven to not yet be tamed. And so it's that level of uncertainty that makes interest rates higher, that makes the affordability for 1 to 4 family real estate even more challenging in today's environment. And we're in Austin, Texas, and so Austin certainly has an affordability challenge.
Yeah, you've had a lot of tech companies move into that region, we do know, in recent years, and it has been booming. I've seen it with my own eyes a few years back in visits. All of these things considered, how and where do you believe the first big changes in consumer protections would be if we did see the CFPB see its responsibilities disbanded?
So I think it's interesting. If we look back at CFPB, they have returned about $21 billion to consumers in the form of fines against very large financial services companies. And so if those protections go away, I think we're going to see Americans pay higher fees for their bank accounts, for their checking accounts, higher transaction costs. And so that's going to even impact the affordability issue more as people pay more for their banking services.
If you had the ear of the Department of Government Efficiency and those who have interest in running it right now, what would you tell them about the needs for the CFPB to have a more sustained footing going forward?
So it's my opinion that the CFPB is needed. It needs some reforms. It has a single director now, and I think a multi-director, a board of directors, a bipartisan board that provides oversight for consumer protection would be important. I also think the funding mechanism needs to be repealed and not draw directly from the Federal Reserve for their funding and go through the appropriations process like everyone else. But consumer protection is needed. It is a valuable service that they provide to people of modest means primarily, and those are the people who need protection.
Kendall Garrison, thanks so much for taking the time. Appreciate it.
Thank you.
A programming note on this week's episode of Stocks in Translation, Jared Blickery and Sydney Freed sit down with Keith Bliss, who is the BlocksCross Global Head of Markets and Strategy, and Keith discusses who is a target of debanking. Let's listen.
Debanking is mostly, Sydney, as I said, it's mostly happening to cash handling businesses or businesses that are participating in the digital assets, the cryptocurrency businesses. And I think
so if they accept like Bitcoin as payment?
Yes, exactly.
Okay.
Exactly. So the banks don't like that because from our knowledge, is they have a misunderstanding of what the companies are actually doing, and their primary concern, from what we can glean, is that they're worried about those companies are laundering money.
You can watch Stocks in Translation every Tuesday and Thursday at 8:30 a.m. Eastern or on Yahoo Finance or wherever you get your podcasts. Coming up, we're breaking down why you might see some people taking their homes off the market, plus the changes you can still make to lower your taxes ahead of April. picture of the U.S. housing market isn't that pretty right now. Despite some recovery in inventory, sales of existing homes in the U.S. fell to their lowest level in 30 years in 2024. High mortgage rates and home prices have hindered activity in the market, and new data from CoreLogic is highlighting further issues. Joining me now on this, we've got Yahoo Finance senior reporter Danny Romero. Danny, what's this new data telling us?
Brad, America's housing market can be described as dysfunctional. New data out from CoreLogic shows that nearly 73,000 homes were pulled from sale after they couldn't find a buyer in December. That is a 64% increase for the same month in 2023. Now, for some context, delistings are usually common in the winter months because there's just not a lot of housing activity during the colder months. Now, this data does signal that some sellers are pulling their homes temporarily because they think that they could have a better advantage during the spring selling season. Now, remember, the spring selling season starts right after the Super Bowl, but home sales start picking up in March and in April. Now, another factor that is weighing the housing market is there's a lot of housing inventory that is piling up. Redfin reports that new listings are up 7.4% year over year during the 4 weeks ending February 9th. That is the highest level since 2022. Now, some agents are reporting that there's still some house hunters that are looking into buying right now, but we'll just have to wait and see how this spring selling season is going to turn out. Brad?
Danny, on another note, we're coming up on Valentine's Day, and Zillow has some new data that shows the big sticker shock of being single and renting an apartment. Tell us about that.
Yeah, there's a price to pay to live alone. Zillow found that the singles tax, which is the extra money that solo renters pay compared to people who live with a roommate, or with a partner, that jumped to a record high of over $7,500. Now, this singles tax has increased more than $450 from last year due to the increase in rent prices. And New York City once again holds the top spot. Solo renters pay an annual premium of over $20,000. So this really proves, Brad, that the independence really comes at a steep price.
Yeah, Danny, we're going to be continuing to monitor this. We know you will be too. Thanks so much. Retirees, you have just over 2 months before your 2024 taxes are due, but it's not too late to lower your tax burden, even though the calendar says 2025. Here to break down some of the common ways to save, we've got Yahoo Finance's Carrie Hannon. Carrie, what are the 4 things that you can do right now to lower your taxes?
Hi, Brad. Yeah, there are 4 things you can do. The first thing is if you've had some earnings in 2024, even if you're retired, you may have had some contract income or you were a part-time worker in some way. You did a little bit of gig work along the way. So if you have earned income, be sure to contribute to an individual retirement account. So you can set aside $7,000. If you're under age 50, if you're 50 plus, you can put aside $8,000. This is just a great way to lower your taxable income today. But if you think that if you're already in a pretty low tax bracket, I encourage people to look at this opportunity to invest that IRA money into a Roth IRA, because you're not going to get the deduction right now for the 2024 tax year, but you can take that money out tax-free when you do, and the money grows tax-free. So this is really a great opportunity to do that for your future. The number 2 thing is to consider a health savings account. If you haven't already contributed to your HSA and you're in a high deductible plan and you are not enrolled in Medicare yet, this is an opportunity to get some savings here. If you can set aside $4,150 if you're an individual, and that bumps up for a family plan. But if you're over 55, you can toss in an extra $1,000 in this HSA. And what I absolutely love about HSAs, Brad, is that this money goes in, it's tax-free going in, it grows tax-free, it's tax-free coming out if it's for qualified medical expenses. So this is really a win-win for people saving for retirement, because a big bulk of your expenses in retirement may very well be medical costs. The third thing is to look at your deductions. Right now, itemizing is a bit of a headache, right? It's like, oh, who wants to do that? And the standard deduction is quite high these days. It's $29,200 if you're married and filing jointly, and $14,600 if you're single. That bumps up for people over 65 as well. There's an additional $1,950 if you're single for your standard deduction, and if you're married filing jointly, it's another $1,550 for each of you. So that's great news. But the point is, you might want to itemize if your medical costs, your unreimbursed medical costs, are more than 7.5% of your adjusted gross income, because that's a big bulk. So you may find that you may get a better deal if you really break it all down, if you had a very expensive year medically. So take a look at the standard deduction versus itemization to see what's the best deal for you. The fourth thing is just kind of scout around and see what other tax breaks might be out there. Lots of cities and counties and towns and states have special tax breaks for people who are 65 and over. You have to do a little sleuthing maybe. I know I live here in Washington, D.C., and property taxes can be reduced by 50% if you're 65 or older.
Carrie, thanks so much for taking the time breaking these down. Appreciate it. So a final check of the markets as we're taking a look at the major averages. We are up across the board. Dow's up 0.25%, S&P 500 0.5%, Nasdaq 0.7%. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time.
Time for Yahoo Finance's Market Minute. Stocks higher as investors digest changing trade policy and sticky inflation prints coming in better than expected. Reddit shares lower as user growth falls short of Wall Street's expectations. The company saying changes in Google's search algorithm impacted traffic in the quarter, but things have since recovered. Deere forecasting a challenging year for the agriculture sector, sending shares lower. The company maintained its guidance for fiscal year 2025, including a 30% drop in U.S. large equipment sales. The company is expected to feel the impact of President Donald Trump's tariffs if they do go into effect. And Crocs shares jumping as the footwear company reports early progress in its Hey Dude brand. And that is your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan that QR code below to track the best and worst performing stocks of the session.